Welcome back to the BD Daily Finance News Podcast, where you get daily insights on markets, the economy, and investing. I'm your host, and this is the Beyond Daily Finance Show for 2025, December 3rd.
And I'm your guest. Today's episode is basically, jobs are slowing, markets are partying, gold is wobbling, and Bank of America just walked in like, hey, 2026 might kind of suck.
We're going to hit four big stories. 1. U.S. private payrolls unexpectedly losing jobs. 2. Stocks jumping as traders bet the Fed cuts rates at its final 2025 meeting. 3. Gold prices slipping after recent record highs. And 4. Bank of America's warning about an AI air pocket and a tired consumer in 2026.
So if you've been wondering, is my job safe? Is my 401k okay? And should I be hoarding gold coins like a dragon? This one is for you.
Let's start with the jobs data. ADP and other private payroll trackers say U.S. private employers shed around 32,000 jobs in November. That's the third time in 4 months that private payrolls have actually fallen.
The job market, which has been doing CrossFit for 3 years, just sat down on the couch and said, I'm tired. And small businesses are leading the slowdown, right?
Exactly. The reports say the steepest cuts are at small firms. Think local restaurants, small retailers, contractors. When they see demand soften or costs stay high, they cut hours or positions first.
For a normal person with a job, what does private payrolls down 32,000 actually mean? Should they be panic refreshing LinkedIn?
Think of the labor market like a crowded restaurant. For the last few years, it's been overbooked. Employers were begging people to come in. Now, a few tables are opening up. It doesn't mean the place is empty, but it's no longer a frenzy.
So instead of getting 3 job offers and a signing bonus, you might get 1 offer and we can maybe do free coffee.
Pretty much. Wage growth tends to cool when hiring cools. Employers don't have to fight as hard for talent. That can be good for inflation, but not great if you were counting on big raises to keep up with prices.
And we've got that other ADP stat floating around, that November private payrolls unexpectedly fell by 32,000 after October was revised up to a gain of 47,000. So it's not a straight crash, it's more like a wobble.
Right, 1 month doesn't make a recession, but 3 drops in 4 months is a pattern you pay attention to, especially when it's concentrated in small business, which is a big chunk of U.S. employment.
Okay, give people something practical. If you're hearing jobs are weakening and you work at a small firm, what's the move?
3 simple things. 1. Shore up your emergency fund. Aim for at least 3 to 6 months of expenses. 2. Quietly refresh your resume and LinkedIn. 3. If you're in a very cyclical industry, consider upskilling into roles that stay in demand even in slowdowns, like data, compliance, or maintenance-heavy roles.
So the vibe is not panic and move into a bunker. It's more, maybe don't quit your job on a Tuesday because you saw a TikTok about van life.
Now here's the twist. This weaker jobs data is exactly why markets are betting the Federal Reserve will cut rates at its final policy meeting of 2025. Traders see a slowdown. They assume the Fed blinks.
So Main Street is like, I might lose my job. And Wall Street is like, champagne, because my borrowing costs are going down.
That's basically the dynamic. The reports say stocks rose while bond yields and the dollar dropped on more evidence of a slowdown in the U.S. jobs market. Lower expected rates mean higher stock valuations, especially for growth and tech names.
Okay, let's explain the rate thing like I'm 5. Why does a weaker jobs report make everyone bet on rate cuts?
Think of interest rates as the price of money. The Fed keeps that price high when the economy is running hot and inflation is sticky. When growth cools and unemployment starts to creep up, they lower the price of money to support borrowing and spending.
So if you have a mortgage, a car loan, or credit card debt, a rate cut is like your bank quietly turning down the difficulty setting.
Exactly. And for investors, lower rates make future corporate profits more valuable in today's dollars. That's why you see stocks jump when yields fall. The Bloomberg wrap literally said stocks rose and bond yields dropped alongside the dollar on these rate cut bets.
Is there a risk the market is getting ahead of itself? Like, the Fed hasn't actually cut yet. This is just everyone guessing what Jerome Powell will feel in his heart next week.
There's always that risk. If the Fed comes out and says, we see the slowdown, but we're not cutting yet, you can get a snapback. Stocks down, yields up. Markets price in the future, and sometimes they overdo it.
Action step here for regular humans, that's a window to shop for better deals on mortgages, refis, and maybe consolidate high-interest credit card debt, right?
Yes. If you're sitting on variable rate debt or double-digit credit card balances, use any dip in rates to either refinance or aggressively pay down the expensive stuff. Lower rates are a gift. Don't waste them just bidding on more meme stocks.
And on the investing side, this is a reminder not to build a plan that only works if rates keep falling forever. We've all seen that movie, and it ends with sad bond funds.
Speaking of sad, let's talk about gold. After hitting fresh highs recently, gold prices have retreated to around $4,205 an ounce, down about 0.6% in the latest session.
Which is funny, because you'd think jobs weakening, Fed cutting, uncertainty rising, gold should be on a rocket ship. But instead it's like, nah, I'm just going to take a nap at 4,205.
The market commentary says this drop is mostly technical profit-taking. Gold rallied hard from support around $4,056 to those recent 6-week highs. When traders see a big run, they lock in gains, even if the fundamental story is still supportive.
So it's like you finally hit your step goal for the month and then reward yourself with 3 donuts. The long-term health story is fine. You just needed a break.
Exactly. Fundamentally, weaker U.S. data and a more dovish Fed narrative tend to be good for gold. Lower real yields, softer dollar, more demand for hedges. But short-term, charts and trader behavior can dominate.
A lot of listeners don't hold physical gold bars under the mattress. They have gold ETFs. And CNBC has been reminding people that the tax treatment on those can be tricky.
Right. Some gold ETFs are taxed like collectibles in the U.S., with higher maximum tax rates on gains than regular stocks. So if you're trading gold ETFs like they're tech stocks, you might be in for a surprise at tax time.
So what's the takeaway? If you bought gold as a long-term hedge, this kind of 0.6% daily wiggle shouldn't freak you out, right?
Correct. The key is knowing why you own it. If gold is your sleep-at-night insurance against inflation or financial stress, you don't micromanage every pullback. But if you're chasing short-term spikes, understand you're basically trading sentiment and technicals, not a steady income stream.
And maybe talk to a tax pro before you turn your whole retirement account into shiny metal just because TikTok told you the dollar is going to zero next Tuesday.
Let's zoom out to 2026. Bank of America is warning about a potential double whammy for stocks, an AI air pocket, and a struggling consumer. They're basically saying, don't expect outsized S&P 500 gains next year.
An AI air pocket sounds like when your fancy chatbot suddenly goes, I'm sorry, I can't help with that, and your stock price drops 10%.
In market terms, it means AI-related capital spending and hype could slow. Companies have poured billions into chips, data centers, and software. If revenue growth doesn't keep up, that spending can flatten or pull back, hitting earnings and valuations.
So it's like everyone bought the most expensive gym membership, the shoes, the outfits, and then in 2026 they remember, wait, I actually have to go to the gym for this to pay off.
Exactly. The second part of the double whammy is the consumer. After years of inflation and higher rates, plus a lot of spending on travel and goods, the U.S. consumer may finally be tapped out. That hurts revenue for retailers, travel, and discretionary sectors.
We're already seeing hints of that. Discount chains like Dollar Tree are getting more traffic as people chase bargains, while mid-tier brands have to fight harder for every sale.
Right. Dollar Tree just beat sales expectations with an average item price around $1.40 because people are trading down. That's a classic late cycle behavior. Consumers still spend, but they move to cheaper options.
So if 2026 is this air pocket plus tired shopper combo, what does Bank of America want people to hear? Don't expect another 20% S&P year?
Pretty much. Their strategist Savita Subramanian has been saying headwinds are numerous. That doesn't mean a guaranteed crash, but it suggests lower average returns and more volatility. So relying on, say, 8 to 10% annual stock returns every year could be dangerous for planning.
This is where the classic 4% retirement rule gets shaky, right? If the next decade is choppy with lower returns, that safe withdrawal might not be so safe.
Exactly. MarketWatch has been warning that a lost decade of low stock returns can be brutal for retirees. If you're drawing 4% a year from a portfolio that's barely growing, sequence of returns risk hits hard early in retirement.
So, practical move here, if you're within, say, 5 to 10 years of retirement, maybe don't assume the stock market is your magic ATM. Build in more cash buffers, more bonds, maybe even delay big withdrawals if we hit a rough patch.
Yes, and diversify beyond just the hottest AI names and U.S. large caps. If 2026 is a hangover year, the winners of the last 3 years may not be the winners of the next 3.
Basically, don't build a portfolio that only works if hype never dies and shoppers never get tired. That's not a plan. That's a wish.
Let's tie this all together. 1. The U.S. jobs market is softening, especially at small businesses, which means more risk for workers, but also less pressure on inflation.
2. Markets are already betting on Fed rate cuts, which is great for borrowers in theory, but dangerous if you build your whole budget around something that hasn't actually happened yet.
3. Gold's pullback from around $4,260 to $4,205 looks like profit-taking, not the end of the world. Know why you own it and understand the tax angle if you're using ETFs.
And 4, Bank of America's 2026 warning is your reminder to sanity check your expectations. The AI party and the consumer binge might not last forever, and your retirement plan should work even if they don't.
Action checklist before we go. 1. Strengthen your emergency fund, especially if you're in a small or cyclical business. 2. If rates dip, look at refinancing expensive debt instead of just taking on more.
3. Don't chase every spike in gold or AI stocks. Decide your allocation, write it down, and stop letting your cousin's group chat be your investment committee.
And 4, if you're close to retirement, stress test your plan against a few years of lower stock returns. Talk to a planner if you can, or at least run scenarios instead of assuming straight-line growth.
Today's episode helped you feel a little less lost in the headlines? Hit follow, leave us a rating, and send this to one friend who keeps saying, "I'll deal with my money later." Later is now.
This has been the BD Daily Finance News Podcast, the Beyond Daily Finance Show. Thanks for listening, and we'll be back tomorrow with more markets, money, and just enough sarcasm to keep it interesting.